Welcome to Introduction to Accounting, Preparing for User's Perspective. Post journal entries to account ledgers. Congratulations! You now know how to identify transactions using source documents, Step 1, analyze them, Step 2, and record the corresponding journal entries in the company's general journal, Step 3. Next, we need to post the journal entries into the various general ledger accounts, Step 4, so that we can then compute their balances, which will be used to prepare the pre-adjusted trial balance, Step 5. After that, we'll go through this process with adjusting entries so we can prepare an adjusted trial balance, which will be the basis for preparing the financial statements. We will then close all temporary accounts and prepare a post-closing trial balance. Here's a graphic view of the accounting cycle. And as you can see, we are going to work on this section where we take the general journal information and post them into the ledger accounts. So for example, if we had an account receivable account with $700 balance already and posted a $100 debit to it, we could then say we now have $800 of accounts receivable. The posting process is simply transferring the data from the general journal into the respective accounts in the ledgers. And these T accounts are just visual representations of what's called a general ledger account. This posting process is often taught in two different ways in accounting courses. The one on the left is the more common way because we use what's called a T account, but this is just a visual representation of the actual ledgers used in the real world. As you can see, here's a T, and the balance is kept off to the side, whereas in T accounts here, you record the debits and credits and then you draw a line and compute the balance. Either way, it's the same information. So let's just look how it would be done in an accounting course. You have to enter the beginning balances on the respective sides. So this means we have $700 of accounts receivable and have earned $2,000 of consulting revenue before this transaction has even been recorded. We then post the respective debits and credits and can compute their ending balances. We now have $800 of receivables and have earned $2,100 of consulting revenue. The posting process using T accounts to represent the general ledger accounts is visualized here. T accounts seem to be visually easier for students to comprehend, and that's why you'll often see accounting professors using T accounts to teach this material in the classroom setting. Now in the real world, it actually looks more like this in a manual accounting system. Here's the general journal as before, but we've added a new column called the posting reference column. That's where you put the unique numeric identifier for each account from the chart of accounts. So accounts receivable will have its own unique number, consulting revenue its own unique number. As soon as you post the information down here, we'll write in the posting reference number to show that it's been posted. The posting process using realistic manual general ledger accounts is what's being showed in this example. We've posted the debit to receivables, and since I've posted it, I then write in the posting reference, meaning I posted a debit of $100 to the account referred to as 1100. I then posted a credit to the account referred to as account 4100, which is consulting revenue, as you can see below. Once the information has been posted, we can then compute the balance. Positive numbers represent debits, and numbers with parentheses around them represent credits. So we have a debit balance. We've then posted another $100 debit to get to an $800 new debit balance. Here we've started with a $2,000 credit balance. We've credited another $100 to arrive at a $2,100 revised credit balance. This is how it is really done in a manual accounting system, so I wanted you to see that. These are all the journal entries we recorded in the prior video. If you haven't watched that video, go back and watch it. It's called Analyze Transactions and Record Journal Entries, so I won't take the time to discuss them here. This is a listing of all the general ledger accounts that will be affected by the journal entries on this prior page. As you'll notice, all the opening balances are zero because it's a brand new company. Now, if this company were already in business for a month or so, you'd see opening balances. So make sure whenever you start posting that you have the prior balances. In this case, they're zero because it's a new company, but that will not normally be the case. What we're going to do now is post every single journal entry from the general journal. I've created a T account for every single account in the ledger because this is how it's often taught in accounting courses. And I'm simply going to post these debits and credits into their respective accounts. We had more cash debit, we have more equipment debit, and we have more capital stock credit. As you can see, as I post the information to the respective ledger accounts, I put in the posting reference. We have more building, $200,000 debit, less cash because we paid it out, $40,000 credit, and owe $160,000 more on the note payable. So in other words, we bought this building by paying cash and taking out a loan. We prepaid our insurance, debit $12,000, more prepaid insurance, and less cash. We now have more inventory, debit $7,000, and we haven't paid for it yet, so it's a credit to accounts payable $7,000. Accounts receivable is debited to show we have more receivable. Sales revenue credited to show we earned more revenue. Cost of goods sold is debited to show we have a larger expense, and we have less inventory, so that is shown as a credit. Commission expense. We have more commission expense, debit, and more payable because we haven't paid it yet, credit. Accounts payable, debited $4,000 and credit cash $4,000. That means we paid off the account payable using up our cash. Here we were receiving cash, debit. Why? Because one of our customers paid off the account receivable they owed us, credit to accounts receivable. Here we're debiting investments $5,000 to show we have more, and we're crediting cash to show that we used cash to buy the investment, credit $5,000. Now we're receiving $200 cash, debit, and we're crediting dividend income to show we earned it. We then paid out a dividend to our shareholders. Our dividends increased $100, that's a debit, which will wind up decreasing our retained earnings. Our cash decreased because we paid it out, that will be a credit to cash. Utilities expense increased $500, debit, and utilities payable increased $500, credit. Now what we can do, since we've posted all the information from the general journal, we can compute the ending balances. This process is pretty easy. All you have to do is add up the debit side, add up the credit side, take the difference, and whichever side was larger, that's where the balance is. So in this case, we have more debits than we have credits for cash, so the balance will be over here on the debit side. Investments, debit $5,000. Accounts receivable, debit $1,000. Because we had $5,000, we collected $4,000, so now we only have $1,000 remaining to be collected. Inventory, we have debit of $4,000. Prepaid insurance, debit $12,000. Equipment, debit $2,000. Building, debit $200,000. Accounts payable, we had $7,000 credit minus $4,000 debit, so the balance is going to be a credit of $3,000, which is the normal balance for accounts payable. Commissions payable, credit $100. Utilities payable $500, credit. Notes payable, credit $160,000. Capital stock credit $100,000. Dividends, debit $100,000. Sales revenue credit $5,000. Cost of goods sold, debit $3,000. Debit commissions expense $100. Debit utilities expense $500. And credit dividend income $200. Now we have all the ending balances based on the original transactions, which we can then use to create the pre-adjusted trial balance. The way we'd prepare the pre-adjusted trial balance is we'd take all of the debits, list them out, and then take all the credits, list them out, and we'd take the total debits minus the total credits, and it needs to add up to 0. That would prove that debits do equal credits. This is a representation of the cash account ledger. Had we actually used this in teaching this topic, you would have seen that as I posted, each of these would be updated with the running total balance being computed on the right. The ending balance is $41,100, and it matches what we did with the T account, so those two numbers match. The ledger really is just like a T account. We have the T in the middle with debits and credits, and we have the balance showing off to the right rather than a line and down below. I'm going to show you the remaining ledger accounts just so you can refer to them. I won't take any time to discuss them though. If you need to look at any longer, just pause the video. In summary, what we've done is we've gone through every single journal entry, posted the debits or credits to the respective ledger accounts, updated the ledger accounts to compute the ending balances, and now those ending balances will be used to create the pre-adjusted trial balance, which should prove that the total of all debit balances equals the total of all credit balances, and then we're ready to move on to the next phase, which is recording the adjusting entries. Wish you all the best on the quiz. Aloha!